Hi, this is Alan Gassman. It's the day after election night, and thanks for breaking away to watch this less exciting video. I'm here with my friends Ken Degraw and Andrew Barg, and we are going to talk about something that rarely gets discussed and that most people don't know about it, and that is how you tax, how you pay tax, how you report tax on what happens during a bankruptcy. Now, this is part of a 3 or 4-part discussion webinar series on bankruptcy and bankruptcy taxation, and we may even throw more on later. And Ken and Andy and I are working on other presentations, and this, quite candidly, is our dress rehearsal. So we welcome you for this. Thank you for your tolerance. And thank you especially for all your questions. You can post questions as part of the GoToMyWebinar platform, or you can email us questions. You have our email addresses here. Please send Ken and Andy the hard questions. Please send me the easy ones. And we're just going to go through the deck. About an hour after this talk ends, so at about 2:15 Eastern Standard Time, you will receive a copy of the PowerPoint and also a link that you can click on to watch this again or to forward it to anyone you like or anyone who you don't like. So Wednesday, November 18th, you may have already signed up, or you can sign up for another free webinar. We're going to talk about advanced tax planning and strategies for insolvent taxpayers. So we'll be getting into things that we'll lay the predicate for today in that program. And then we'll be talking about Subchapter V, the new part of the bankruptcy code, which really revolutionizes Chapter 11 bankruptcies for most borrowers, with Mike Markham on Friday, December 4th. And we can always add more sessions. Whatever you want to hear about, let us know. Also, I have books on Amazon, and Ken and I are working on a new CPA's Guide to Bankruptcy. The Amazon book for the Estate Planner's Guide to Bankruptcy sells for $85, but if you want to buy it directly from me and skip the middle person, $29.95. And then also Gassman Markham on Florida and federal asset protection law. If you have the Bloomberg B&A portfolio series for estate and gift tax, this is in part of your series, but if you want to buy a hard copy, just let me know, send me an email, we'll be glad to send it to you. Ken, do you want to tell us a little bit about your background and how you became so passionate and immersed in providing bankruptcy-related services?
Thank you, Alan. I appreciate that. Welcome, everyone. I'm partnered with Withum Smith & Brown. I sit in one of their New Jersey offices. The practice is obviously nationwide. My particular corner of the world with Withum deals in our forensic and valuation services section, specifically in bankruptcy and tax crimes. So those are my two places I play. I've been doing this since sometime in the 1990s, way too long to even be thinking about it anymore. And it is a unique area and is getting some renewed views by people who've kind of put it to the side now that Subchapter 5 has come around, as well as obviously the pandemic has put new pressure on businesses.
And Ken, we have a lot of CPAs on this webinar and who will be viewing this webinar. What organizations can they join and what sort of programs can they attend to become much more proficient in the bankruptcy area?
Sure, that's a great question. So there's really, I think there's 3 nationwide, and Andy, you may know some others. The one that is best for financial professionals is the Association of Insolvency and Reorganization Advisors, national organization focused on the financial aspects of bankruptcy. A great organization, a lot of great training programs and some credentials. The American Bankruptcy Institute certainly is out there. They have a tremendous amount of content, as well as I swear every other week they've got another conference going on somewhere in the country. It's primarily attorneys, but there's certainly a spot there for the financial professionals. And finally, the Turnaround Management Association, also as an international organization, focused on professionals in the turnaround space. So it's broad-based, attorneys, accountants, appraisers, auctioneers, a little bit of everything. Again, a great organization to meet people and to expand your knowledge base and networks within this world.
Beautiful.
You know what? If let me just throw in one more, I should be smacked for this one, but it's the Women's Insolvency and Reorganization Conference. I may have screwed that up, but as the name would indicate, it is primarily directed at female professionals in the space, at a national organization, and they do a fantastic job as well, in terms of bringing content and leadership to the females that practice both on the legal and the financial advisory side.
And there won't be a long line in the men's room for those programs.
No.
And then Andrew, you're from Fort Worth, Texas, where I was born and where my mother was born. So tell us just a little bit about your practice and how CPAs interested in bankruptcy can immerse themselves in this area, which I think is going to be pretty busy in a few months.
Yeah. Well, I'm a partner with Barg and Henson. Barg and Henson has been in the bankruptcy space since 1984, really since inception. I was born into this niche via my father as the original owner and principal and mentor, and so I've been very fortunate enough to be mentored by someone who has had a lot of experience both at the small middle market as well as the large market, because he had quite a bit of experience in national firms. But our practice is focused primarily on tax and serving financial advisors and trustees. Typically, I do handle some debtors, but it's most of the time it's dealing with trustees and catering to all of their tax needs, and that's primarily the Northern District of Texas. Although I have had a few cases across the country as well, and I've got 14 years experience now in the bankruptcy tax world, and it has been a fun challenge for me. I do enjoy the challenge.
Beautiful. So that's me. No one has to know anything about me. We do thank the Association of Insolvency and Reorganization Advisors for allowing us to use some of the slides that we have here. We have a lot of topics to discuss: discharge of taxes, priority tax claims, taxation of individuals in bankruptcy, entities in bankruptcy, prompt determination, IRS insolvency, and prompt refunds. So we're going to get right to it. Discharge of taxes, I'm just going to go to an example here. I've got slides that explain this, but if we go to the example on page 17, obviously I cannot file my 2019 income tax return, fail to pay the tax, and then file a Chapter 7 bankruptcy and expect that tax to go away. It just doesn't work that way. The way it works is the tax generally needs to be more than 3 years old. So I could today file a Chapter 7 bankruptcy and bankrupt out my 2016 income taxes if it's even conceivable that I would have gone this far without paying them. In order to do this, under the 2-year rule, which may or may not apply, as we're going to discuss in a minute, not only does the tax need to be for a year more than 3 years back, but I need to have filed an income tax return more than 2 years before filing the bankruptcy. And as you can imagine, there's all sorts of case law on what that means. What does it mean when you file an income tax return if the IRS actually prepared the return for you because you were a non-filer? And then the third thing is that the tax has to have been assessed more than 240 days before I filed the bankruptcy. And of course, if you have filed a return more than 2 years ago, the tax has been assessed, but the tax that's normally been assessed is just what was on the return that you filed or that the IRS filed. If you are under an audit or there's going to be an underpayment situation or a tax fraud situation, then that part has not been assessed. So if you file a bankruptcy during or before an audit, the IRS says, oops, let's look at this, we'll assess some more. That is not going to be bankrupted out. And there is, I did have a slide, here you go, the McCoy decision, which really confuses the question of when was this return filed, and also discusses another issue, which comes up as to whether if you file a tax return late, are you even able to bankrupt it out? So there's things you can read here. This has been interpreted differently in different districts, but that is bankrupting out taxes 101. Priority tax claims under the bankruptcy code, it describes the hierarchy of who gets paid and doesn't get paid as among the unsecured creditors. And let me mention, by the way, even if you have a tax debt that's more than 3 years old, if the IRS filed a lien, that lien will still apply against the assets for the tax monies not paid to the IRS, even though you can theoretically bankrupt the tax out. But for people who have debts, who file a bankruptcy, where as to the assets not subject to the lien, the domestic support obligations, alimony and child support, get paid first. Then the administrative expenses charged by the bankruptcy case, just like in probate, the funeral home gets paid first. Then if there was an involuntary bankruptcy, the claims relating to that petition, then wages that you owe to employees up to $13,650, then your contributions to pension and other employee benefit plans, then what you owe for grain products and fish for fishermen, consumer layaway, et cetera, et cetera. So just so you know, there is something called the absolute priority rule, and these are the things that merit getting paid if there are assets to pay them. But now getting to the substance of our presentation today, Andy's going to start off. He's going to spend about 22 minutes on individual bankruptcy and how it's taxed. And Andy, are you able to control the slides? Or if not, I'll be glad to turn them for you. You got it.
Yeah, it looks like. Okay. Well, thank you very much for that commentary, Alan. I thought that was great. I do want to back up a minute and say that these are kind of a general overview, and that there are defenses that the IRS can assert even if you fall within these three criteria of getting a tax discharge. And typically, one item they'll go for is constructive fraud. So if you spend all this money on things you probably shouldn't have been spending on, you need to be aware that there are other defenses that the IRS does have available. But let's jump into individual bankruptcy estates. It's a lot of material in a very short amount of time, so I do apologize for that. And let's just jump into it. So the first thing you need to realize is that Section 1398 establishes a separate taxable estate. If you can conceptualize, it's like a light switch going off, if you will, and the debtor dies and is born again on the same date. Okay, so that's one concept I'm going to start with, and I think it'll be easier for you to understand. And I'm going to use a little bit of a visual here too, but that's all provided in Section 1398. Generally, all of the non-exempt property is going to be transferred into the bankruptcy estate. Section 1398 does not apply in cases where a case is dismissed. So sometimes you can actually end up having to amend these estate tax returns in that situation and basically zero out those returns and then file all the activity under the debtor's return. And it's important to realize that the debtor is still responsible for reporting his income that is exempt from the bankruptcy estate. So you've kind of got this short period leading up to the case that the debtor is still responsible for. Okay, the income pre-petition does not flow into the bankruptcy estate, and then the debtor is also responsible. And I'll just use like a paper sign here. For this post-petition period for income that's not property of the estate. And that's typically, in a Chapter 11, you need to realize that anytime the debtor is receiving wages, the debtor is still going to be responsible for this pre-petition tax year wages. But for a Chapter 11, those wages are going to be considered income of the estate. You're going to include that on the estate tax return. For a Chapter 7, that is not the case. The wages are not going to be, the post-petition wages are not going to be reportable by the bankruptcy. Another example is like retirement distributions, generally exempt from the bankruptcy estate. The debtor is still going to be responsible for filing taxes and paying tax on that exempt income. Okay. In the case of a spouse, if both spouses filed bankruptcy, you're going to have two separate taxable estates. If only one spouse files, it's just going to be one taxable estate, and it's only going to cover that filing spouse's income and property. So that can super complicate matters. Let's move to the next slide. The tax compliance, the actual tax return you're going to file for the bankruptcy estate is going to be a 1041, and that's going to be like a cover page, and then you're going to use a form 1040 behind it to use as a supplemental worksheet. And then at the top of that 1040, you're going to write attachment to form 1041, do not detach, and that is to help with the IRS processing. You can look at IRS publication 908 has got a little more material there that I'll also be referring to as these slides go along. The individual bankruptcy estates cannot be e-filed. At least that's my understanding. Maybe you guys, but the IRS is not set up to process those. I think in the future you might have some, but it's just there's not so many filings that the IRS is focused on that. The tax rates and the standard deduction that you use for an individual bankruptcy estate is the same for that as a married individual filing separate, and that's true regardless of whether or not you're married, regardless of whether or not the debtor is married. So that's kind of odd. It follows the same filing thresholds as a married individual filing separate, and the tax is payable by the bankruptcy estate. So that's important. If for whatever reason you end up with a bankruptcy estate that owes tax and can't pay it, I think number one, either the accountant or the trustee or both have probably done something they shouldn't have, but if there is tax there, it does not jump to the debtor. And that's important. Revisiting how the tax is computed, Section 1398 provides that the tax on the taxable income of the estate shall be determined under subsection D of Section 1. And I encourage everybody to read that. What you will not find in Section 1 is references to alternative minimum tax, net investment income tax, additional Medicare tax, or even self-employment tax. And it is my position, as well as the position of the AIRA, and has been for years, that the individual bankruptcy estates are not subject to these taxes. I've had that position upheld on audit as well, and so I am comfortable with that. Oddly enough, the self-employment taxes under current case law are payable by the debtor. So he would report that on his separate 1040, not the bankruptcy estate return. That has not always been the case. I think some of the old publication 908s, I looked at it, it seemed like that it was an option that the debtor could pay that tax and kind of get credit towards Social Security tax, what have you. It's really been recently where they've come out and they've got this case law now that allows them to enforce the provision that I really think strikes against the core of the concept of a fresh start for debtors. So I look for relief from there. But let's move on to the tax attributes. This is obviously very important as well. I mentioned the light switch that goes off as if the debtor dies. All of the tax attributes that the debtor has leading up to the case transfer into the individual bankruptcy estate. I say all, but there are some exclusions. It's going to include most of your tax attributes. NOLs are common. The character of the items of property or perhaps income. We got long-term, short-term capital gains, what have you, maybe undercaptured Section 1250 property that's out there, passive losses and suspended at-risk losses. Those are big ones I usually see. It does not include depletion carryovers and investment interest expense carryovers. If you look at the statute of Section 1398 and the related regulations, if an attribute is not on that list or the list on the regulations, then it stays with the debtor. When the case closes, if there are these tax attributes remaining, they will the debtor will succeed to the attributes of the bankruptcy estate post post closing of the case, or confirmation of a confirmed plan can also trigger that transfer. But you need to be aware that there could be cancellation of debt issues out there that will reduce those attributes. And sometimes the estate tax term may not capture all that reduction because it may not be known as well. You could have years down the road before you actually get a final determination on what the true amount of the debt that was canceled, because you've got payment plans, what happens if they fail, and then you end up back in Chapter 7. Let's jump to the estate's tax year. I mentioned the light switch going off. When the debtor dies, if you will, the light switch goes off. That is the beginning of the year that the taxable year of the estate. Individual bankruptcy estates, exactly like decedent estates, they can select a fiscal year. That can be very powerful. Obviously, if you think in terms of K1 is actually considered as if it was earned on the last day of the year, assuming a calendar year. So you could potentially file in a December, and you could select a fiscal year end that ends November 30th, and effectively defer tax on that K1 income 11 months, which can be pretty powerful, okay, and important. The debtor's short year election, okay, this is very important. If you don't listen to anything else in this conversation, I want you to know that I have seen bankruptcy counsel causes of action against bankruptcy counsel for failure to advise debtors on the short period of election, and we've had some of our members speak to the group down there, and I think it was Houston where that problem arose. But the debtor has the option to select to make a short year election, and only the debtor can do this. Okay, so let's go back to my light switch, and you got this pre-petition short year here leading up to it. Okay, and why you want to make this selection or not make this election, because it can be a powerful tool. The tax attributes that we discussed earlier, that they kick in, they transfer to the bankruptcy estate as of 1/1 of the taxable year if you do not make this election. Okay, if you make this election, the debtor can use his tax attributes as of 1/1 of the year for this short period return, and then the individual bankruptcy estate does not succeed to the attributes until the end of this taxable year. Okay, so that could be very powerful. And if you also think in terms of if the debtor needs these attributes, a lot of times he does. Sometimes the debtor can actually generate attributes in this short year leading up to the case. And in that situation, if the debtor was generating tax attributes in this short year, he could keep these tax attributes, and they would not flow into the bankruptcy estate, because again, the bankruptcy is going to take what's available at 1/1. If you generate loss attributes over here, you don't make the short year election, the debtor is going to be allowed to keep this and apply it towards. I mentioned my paper over here, that this other return that's going to have to be required for income that's going to include income that's not that doesn't belong to the bankruptcy estate. Likewise, if you think there's going to be tax in this short year that the debtor is going to have to pay, you want to file the short year election, because the estate is going to be responsible for that tax. If you're going to get a refund, you might not make the election. Likewise, not, whether or not the estate would still get that refund once you file your calendar year, the 12/31 year-end tax return is another matter, and it may very well grab that refund, but there could be situations where that may not be the case. And I've kind of gotten ahead of some of my slides here, but I do have some material in here that lays out how you make that short year election, and I encourage you to read that as well as publication 908. I did mention that what's common in the wages, where you have the wages that become property of the state, but there could be other taxable items. But for a Chapter 11 in that situation, there's a notice 2006-83 that lays out instructions and even an illustration on how you allocate pre-petition income and post-petition income. And that's going to be a statement that you're going to put on front of the 1040 worksheet. And that is how you file that and make those allocations. The administrative expenses are very important. Generally, administrative expenses are going to cover most expenses of the bankruptcy estate, and they are deductible by the bankruptcy estate. Now, there are certain items that aren't deductible, like in the case of federal income taxes that you pay, and some capital expenditure items I have on there, and there might be a few other, but this is generally the list. How you deduct those administrative expenses, generally, you're going to deduct them as a negative item of other income on the 1040. However, I do, to the extent that you can allocate these expenses to a Schedule E, C, E, or F, or maybe even a Schedule D activity, if the facts allow, I do encourage that, and I'm going to get into that more why here on the next slides. But you also need to consider the proper timing of the deduction. A lot of times these cases don't pay the fees out until the end. I've talked with my peers and others where some of my peers have mentioned that they do accrue these expenses sometimes when they need to. But the service has kind of backed off of pushing back from that position. Part of that reason is the existence of a separate administrative expense carried forward or carried back that is stated in Section 1398. And this is separate from any net operating losses. So if you recall, one that long ago, we couldn't carry back NOLs. Well, you can carry back administrative expenses, okay? But you cannot carry back administrative expenses to a pre-petition tax year of the debtor, okay? And this is why I advocate for allocating these things on Schedule E, F, or what have you, because they could be reasonably allocable to a business and can create an NOL that could be carried back or possibly carried forward and survive post bankruptcy estate. An administrative expense carry forward does not carry forward to the debtor. So it stays with the bankruptcy estate. You can't use it to generate refunds pre-petition. And real quick, I'm just going to touch on the. Oh yeah, no, back to the admin and carryback. If you do have a administrative expense carry forward and carryback and a net operating loss, the two are going to be treated as if they're stacked on top of each other, and you are going to consume the net operating loss first, and then you are going to consume the administrative expense carryover. Okay, just real short on the property transfers to the bankruptcy estate and back to the debtor, sometimes on abandonment, are not taxable events per se. However, as a practical matter, if a trustee abandons property back to the debtor, it's usually encumbered with a lot of debt, and it's not worth the hassle of selling. Well, that abandonment is usually followed up by an immediate foreclosure by the debtor, and there's not a lot of case law out there that really clarifies whether or not that responsibility, because if the creditor does foreclose on it, it is a taxable event. But who reports that? It's a bit up in the air. In my practice, I usually report it on the estate tax return if I can see that there is no harm, no foul. I look at it as an opportunity to help the debtor on matters that could come up post petition and really cause a lot of confusion. Ken, I understand you do a lot of work with bankrupt entities as well. What can you tell us there about your practice and some of the things you see?
Fantastic. Well, thanks for that, and I appreciate you taking the heavier lift here. The individual components of compliance is significantly more complicated and nuanced than it is for entities. So I get the easy lift for today. Entities so there's good news and bad news. And we'll start with corporate entities first. So corporate entities, nothing changes. It's a beautiful thing. Unlike the individuals that we just finished talking about. Your tax year stays the same, your federal ID stays the same, your activities pre-petition for that stub period, as well as your activities during the time within the bankruptcy and the tax year, so all gets rolled up and reported on the corporate tax return and continues to roll forward as if nothing had ever happened. So from a compliance standpoint, corporations are significantly less nuanced than trying to deal with an individual, having lived both worlds. Some of the things you need to think about with on the corporate side of things is the S election, and there's been a number of cases across the country where they have attempted to void the S election within the bankruptcy. And if you think about it, what's the issue? What goes on here is that the bankruptcy estate may be selling the business or maybe selling assets within the estate itself, which, because of accelerated depreciation or whatever the issue may have been over the years, generates a tax gain. On a pass-through entity like an S corporation, that tax gain is going to get passed through to the original shareholders of that S corporation. What's not going to get passed, however, to those shareholders of that S corporation is the cash to pay the tax bill with. So the angle has been to try and void that S election to kind of stop that bleeding and avoid that from happening. You can't do that. It's probably the shortest way, the easiest way to put it. The S election has been deemed property of the estate and would be a fraudulent conveyance if it were to be voided within the bankruptcy. It's a little less clear if it's done before the bankruptcy, but I imagine we could still drag it into a fraudulent conveyance, constructive fraudulent conveyance claim. When you start dealing with partnerships and LLCs, it gets a little more complicated. Not over the top, but it's definitely some more nuance going on here. So similar to the corporate entities, there's no separate tax year. The old technical termination rules are gone, so we don't have to worry about any of that anymore. There's no separate entity being created here, and there's no division of interests of the partners, both pre and post petition. Whoever owns that partnership interest on the last day of the partnership's tax year, similar to what Andy just mentioned, is the owner of that partnership. There is no bifurcation going on. It's a question that just comes up continuously. Same federal ID number, that doesn't change. So one of the other nuances of partnerships versus a corporation, obviously, is that a partnership, if it has neither items of income or loss, doesn't technically need to file a return. What you need to be thinking about, though, is if you're dealing with a trustee, is, as we all know in the tax world, if you're not filing a return, the statute doesn't run. The trustee is a fiduciary. If you want to protect them and just get that clock running on that statute of limitations, you may want to just file a non-return and call it a day. It cuts both ways. I've done it both ways. I don't really have a preference there other than, I get to know my trustees and they'll usually have a process that they prefer. Similar to the S election, the check the box election also can't be voided in the context of a bankruptcy. So if you're a partnership, you stay a partnership. If you're being taxed as a corporation or an S corporation, you remain as such. Nothing changes there and you can't void that. If you're dealing with withholding issues, and this becomes a little bit of an issue, obviously, you may have FACTA issues or you may have non-resident shareholders where you need to be concerned with withholding issues. All those rules still apply, and that can become a problem because you're using cash of the estate to pay those withholdings. That needs to get worked out in the context of the estate. Some of the other challenges we have in the context of a partnership are basically some of all these new rules that we're now confronting in the last really 2 years. We all know that we got a pass last year on reporting partner basis on our K1s. We're not expecting that same waiver for 2020 returns. So we're going to need to start reporting partner basis on these K1s. Anybody who's been around this world for a while knows that the records we tend to get are less than pristine, to put the positive spin on it. And you may be in a position where you've got to basically do the best you can to come up with what the individual partner's basis may be, including maybe getting some confirmations from the individual partners. And as what we also do with all of our entity returns is we attach a disclaimer, essentially saying we did the best we could with what we have, which wasn't much. Good luck, Mr. IRS. Have a nice day. You may want to consider some disclaimers with your return specific for partner basis and some of these other issues, quite honestly. QBI should be fairly evident from the return that you're doing. I've had a number of returns where I am missing the year leading into the bankruptcy was never filed, or sometimes years. So an 18 return may not have been filed, and or there's no information available for the stub period, just because there's just no books and records. So again, we're going to create the disclosures for the QBI as best we can with what we've got. And that would certainly be something you would want to identify to your underlying partners, that there are some clear issues with QBI. 163J shouldn't present an enormous hurdle. Again, if you're missing records and blocks of information, that could become a problem to comply with. Since that was effective in 18, you now have this marvelous person called the partnership representative who needs to be a partner in the partnership. That will not thrill your trustees who can't be named as the partnership representative. And if the IRS comes knocking, who exactly is it that's going to represent this partnership on audit? It cannot be the trustee in theory. The IRS can certainly work their magic and change things up. What I've also been doing, particularly with my partnerships that can qualify, is electing out of the BBA, so that now we don't have to worry about those rules. And then you kind of get into also the issues of, if the IRS does come in and assesses against the partnership, is the partnership actually going to be able to, in a position to have to pay those taxes? How do we get that pushed down to the underlying partners? This is all new territory. I have not had a partnership yet get audited under BBA, whether in or out of bankruptcy for that matter. So, this remains to stay tuned on this one as to how this all ultimately plays out. Anyone who has experience with this, I would love to hear it. There are a number of other taxes out there that obviously still need to be complied with. Nothing new here. Payroll, reporting, withholding, nothing changes there. FBARs, again, this is make sure you're not missing FBAR filing requirements if you're dealing with entities with foreign accounts, whether that be corporate or partnership, or individual for that matter. You certainly don't want to set up a situation where you're getting tagged, or the estate or a trustee is getting tagged for those monster penalties that come along with reporting issues. And so, as I mentioned, FACTA still needs to be dealt with in terms of the withholding. You do not get a pass. Starting to run a little down on time, so I'll kind of push through some of the shorter issues we've got here. There is something called a 505B election. 505B is a magical thing. Is filed by a trustee in bankruptcy, so this is typically going to be a Chapter 7 issue. It is done by filing a separate copy of the return with the IRS and the states, for that matter. And what it does is it shortens the time period for them to challenge the return down to 60 days, and then gives them another 180 days, sort of, kind of, to complete their examination. And that certainly can be extended. So in terms of that statute of limitations and getting a tax year closed out, a 505B election is something that absolutely should be part of your bag of tricks that gets done. The rev procs are listed there if you want to look at it. The IRS has stated that they do want these faxed in due to COVID. There's the fax number. It is done, as I mentioned, by sending in a written request for the election to the centralized insolvency operation in Philly, and the information that's indicated there needs to be in that election, which you typically have at your fingerprint tips, rather. The trustees typically are very attuned to doing this, so it's not anything crazy for them to do. You do typically need to reach out to the individual states to find out where the filing address is. I usually deal with that on a one-off as it comes up. Some states are just easier to deal with than others, as we all know. The IRS Insolvency Group, however, is a fantastic group of people. And I honestly mean call a friend at 800-973-0424. They will help you out if you're dealing with a bank. Every bankruptcy is assigned to someone in the insolvency unit. It's in their bag of tricks. They may not be familiar with your specific facts and circumstances, but they will help you get answers as you go. A couple other publications, Andy mentioned 908, or it may have been Alan, I apologize, and the link to the IRS website for bankruptcy trustees, which has some additional information on it. What I have noticed in some cases, particularly individual debtors over the years, is that for whatever reason, as the petitions are being filed, the IRS is not included in the creditor matrix and is not getting noticed. So I will call asking questions on a filing, and they'll go, "What do you mean you're in bankruptcy?" And then we have to jump through some hoops to get them on the IRS's radar. So be prepared for that. Proof of claims, well, the IRS will be pretty good at filing their proof of claims if they've been noticed. Be attentive to them. The IRS is working with the information they have on hand, and they will estimate, as will the states. I know New Jersey, where I am, estimates big numbers because they want to get your undivided attention to get you going. Certainly get a transcript of the tax periods so that you can see what's going on there. And the automatic stay typically stops most things, but does not stop audits, nor does it stop criminal investigations. So if you've got any of that going on in your estate, be attuned to it. It's not going anywhere anytime soon. I think we mentioned the levies. In the last couple minutes we got here, we got two last topics. Any prompt refunds?
Yeah, just real quick. You mentioned a lot on the section 505A. I'm not going to reverberate, but generally you need to understand that the bankruptcy court just does have jurisdiction to determine taxes, fines, and penalties. That there are some exclusions to that jurisdiction, such as the case where the amount was already contested and before adjudicated by a judicial administrative tribunal of competent jurisdiction. Refunds in particular, there is this 120-day period where within this 120 days of the filing for claim a refund, it's the IRS has sold the jurisdiction. If it's a state, obviously the state would have sole jurisdiction, and they will come out typically and try to wrap up their audit within that 120 days. As a practical matter, I've when it does come to more contentious issues and we have a lot of back and forth, we usually do go over this 120 days, and it ends up being jurisdiction of the bankruptcy court. It does ad valorem taxes. Is one area where you can't really draw it out. If you can't go beyond the period that applies under non-bankruptcy law for appealing the appraisal. There's a Rev Proc 2010-27 modified by 2011-27 that 2011-77 that provides procedures to request a prompt refund of tax. It's got the same mailing address as IRS insolvency. They want you to have statements on the top of the return that kind of flag it as a request for prompt refund. There's a fax number there. I think maybe it's the same fax number that you had listed, Ken. But I also want to take a step back and say that, in my practice, I do see tremendous opportunities for refund. I would say probably 30 to 40% of my cases, I'm typically going after some type of refund, and sometimes it's just low-hanging fruit. But you do need to realize that the books are often a mess. A lot of times you can't rely on them. You want to limit it to items that are already on the return. Now, individuals, you need to have extra scrutiny the tax attributes that we talked about earlier, especially like on a self-prepared return. You might end up with NOLs that are really more proper classification as a suspended passive loss or an at-risk loss, and those can get you in trouble too. But realize that there are tremendous opportunities out there, but don't push it. You know, the trust. A lot of times you can be hired by the trustee, and you don't want to end up with egg on your face, and you also don't want to drag out a case for what's going to maybe a small refund. But even the audit process itself can be should be expected in most instances, and it can be very hard to get the documentation. So you want to limit it to low-hanging fruit applications of law as opposed to creating new deductions. But sometimes those opportunities do exist, and you know, if you go, it's the facts and circumstances, and also can depend on what's available in the case. But you got to have those conversations with your trustees, and you got to be sharp. You can't, you know, you don't want to end up with egg on your face. That would be worse. You end up with a lot of fees and no refund, and a spoiled reputation. So, tell us about our next session, Kent. I understand, and I'm excited for our next topics.
Absolutely. Let me see if I can flip some. Alan, if you could flip slides, I'm not able to move them at the moment. There we go. Thank you. So we've got a couple of topics coming up on the next one. We'll do a much deeper dive into a couple of specific topics. Foreclosure and abandonment comes up quite a bit, and how to deal with that. COD is everywhere, and there's a million nuances. So we'll spend a significant amount of time going through that. There are a bunch of state and local issues that come up that kind of get less coverage just because the federal government seems to be all encompassing with a lot of this, and the states tend to take their lead. But there are a number of state issues to be aware of. And then finally, we've been talking about debtors throughout, but certainly creditors on the receiving end of a filing also have their own issues with bad debts and other things that they could be considering as a plan works its way through the system. So with that, we'll kind of tie this up. I don't see any questions in the chat box. Alan, I'll flip back to you. I think you're on.
Okay, I have a lot of questions in the chat box. So here's the first one from Jose. Are penalties like the 10% penalty for early IRA withdrawal dischargeable, or are they lumped in with taxes?
I have not dealt with that one. I would think that it's in the nature of a tax, so it would go along, it would follow the tax. Typically, the penalties, if they're going to be discharged, are going to follow the tax.
Yeah,
Okay.
I have seen some penalties that pre-petition that were within the 3 years that the IRS will treat as an unsecured claim as opposed to a priority. Certainly, I've seen that on payroll taxes, where the IRS will take an unsecured position in the penalties, and then a priority position in the actual tax. It can be a mixed bag, but I think it can be reduced to unsecured. In the case itself, if I don't think the individual bankruptcy estate would have that situation because it's a exempt asset. But the individual pre-petition or even post-petition for that year for that activity that he is responsible outside of the estate, yeah, I don't. It's a bit of a mixed bag.
Okay. How does the taxation of a single member LLC work? The client has an LLC that's disregarded for income tax purposes. The LLC has leveraged issues, and the LLC files a bankruptcy. How is that treated?
So for tax purposes, what we typically do is simply prepare a trial balance based on the trustee's information, assuming we're talking about a Chapter 7, and then that just gets incorporated into the Schedule C of the debtor. Same with the Schedule E for that matter. You'll see real estate that will file separately because it's a single member LLC.
Yeah, I do a similar thing. I prepare a transmittal letter for the trustee, and we attach the accounting that will basically a spreadsheet of the transactions, and say, here you go, here's the accounting. You need to report this on your return with a single
Okay.
member.
All right. Is there a new procedure for trustees to intercept a refund? A tax refund, I'm sure they mean. I'm not aware of any.
Yeah, I'm not aware of one.
In practice, I have been able to grab refunds from the debtor's pre-petition year, and I will typically do it just by putting it on the form 1040 that I'm preparing for the estate. I put it on there as a payment, and it'll usually generate an IRS notice, and I will explain to which I'll call up either insolvency or tax practitioner priority line, and kind of go through that this is property of the bankruptcy estate, and I want you to credit this I want you to transfer this credit out of the debtor's return and transfer it into the bankruptcy estate. And I've had success there, but I have not dealt with it a lot, and I'm not sure that there's a formal procedure for it. I've seen other trustees just demand that the debtor file like an amended return and have it refunded, but I've grabbed it in this other way as well.
Okay. Alternative minimum tax net operating loss is a tax attribute like the NOL, goes into the individual's estate, does it not? You want me to read that again? Alternative minimum NOL is a tax attribute like the NOL, goes into the individual estate, does it not? Andy, are you?
Yeah, I think it probably does, but as a practical matter, I don't give a care because the individual bankruptcy estate is not subject to AMT.
Yeah.
So it's not even, it's a moot point.
Okay. And then he said the same question he's very smart. His name is Alan. Are you saying that the bankruptcy estate does not succeed to the tax attributes that exist after the debtor files his short period return? ? The bankruptcy estate has to wait until the end of that calendar year, and thus the debtor gets to use the tax, I guess, attributes if the trustees return.
Yeah. Now, if you go back to the light switch example, if the debtor files a short year election, then the attributes that flow into the bankruptcy estate will include the tax attributes at the end of this short year that the debtor files. Okay, so if the debtor does not make the short year election, then the attributes are considered as of 1/1 of the beginning of the year. And if you got, say, a June 30th filing, and the debtor files a January, makes his election, files a January 1st through the end of June 30th short year tax return, then the bankruptcy estate picks up those tax attributes as of June 30th, basically what is shown on that short year period return.
Okay. When you file an 11 and convert it to a 7, is there one return or two?
One.
Yeah.
Go ahead, Jim.
No, I say if it's a business, it doesn't matter. If it's an individual, there's still only one return.
Okay.
Yeah, and this has been a point of contention I've had with trustees because it comes up a lot. Typically, an individual filed Chapter 11 thinking they can reorganize themselves, and shortly thereafter, or maybe a year after, or maybe a year and a half after, it converts to a Chapter 7, or maybe even a Chapter 11 trustee leading up to that case. And it always irks them when I tell them, well, you know, it's a bankruptcy estate, and you don't just terminate this year and then start anew. It's a single taxpayer entity. You don't have two taxable entities just because it converts, and it really kind of chafes them because sometimes there's tax involved, and usually the debtor doesn't even file his Chapter 11 return. And so he ended up having to file and report income that the trustee had no hand in, what have you. But that's my understanding, and that's how I deal with it in practice.
Okay, so we have time for one more. 1398 attributes flow out at the end of the bankruptcy case. Would the AMT NOL be reduced by gains during the case administration before returning to the debtor? I think the answer to that is yes. You would reduce those attributes by gains that take place in the bankruptcy estate, right?
Yeah, I think you would basically have to go back and make those calculations, ask the trustee for the bankruptcy estate returns, and maybe see if you can work with the accountant that worked on them, and really recalculate all of those AMT items. Now, I'm not going to spend any time working with you, because my final fees will be paid by then, and I might give you some worksheets that might help you out, but yeah, you're going to have to make those calculations yourself.
Okay, beautiful. Well, we thank, if your question was not answered to your satisfaction, or you have another question, please go ahead and just send us an email. You've got our emails there. Please join us Friday, December 4th for more on Subchapter V, and November 18th for the advanced treatment that we've discussed today. Ken and Andy, thank you very much for being great teachers and great mentors to others in this area, for your writings and for your speaking skills. I can see that this area of tax law is just not well laid out, and you're having to, navigate as you go along. So hats off for doing a great job. And I'm sure part of the message here is that bankruptcy lawyers and other professionals need to call guys like you or people like you before they file a bankruptcy and not after, so that you can do the right planning so that the taxes can be reduced to the extent possible. Any final words?
Go ahead, Ken.
No, I was just going to say I've had any number of circumstances where a trustee is either about to sell or has sold an asset in an estate without having considered the tax ramifications because they hadn't retained us yet, all to find out that a very nasty surprise awaited them. So you're right on point, Alan.
Yeah, it seems like it's always a bit too late when I get hired, usually on the back end of these things, and you want to try to build relationships and explain that try to get it through to trustees that's not what you want to do. And you want to devote a lot more attention to these returns than you would a normal return. They require a lot more analysis, and a lot of times there's transactions going on that you may not be aware of, that may not spit out a dollar amount, a cash amount, a foreclosure or something like that, that can nevertheless create tax. And so you really have to give a lot of attention to these and scrutinize those self-prepared returns, and even some of the other returns that come in, and be cautious. It's not an area you really don't go into it thinking you're going to make a lot of money. You need to go into it thinking, man, this is an area that you can sharpen your skills, be far beyond where your peers are. You're going to get a lot of interesting transactions that are going to spawn a lot of research. They're going to make you a very sharp person, but don't do it to get rich, because you're probably going to get burned at one point or another.
But some of the most very successful business people went through bankruptcy and learned a lot of lessons and kept their professionals who helped them get through the bankruptcy through their successes, right?
That's right. I have a very loyal client base.
Yeah, we all do. So I hope for everybody here that your favorite candidate wins the election, as long as he's also my favorite candidate. Have a fantastic afternoon. Let us know other webinar topics that you'd like to have heard. And I hope that you use this information to help others. Thank you. Thanks a lot, guys. You did a great job. Very enjoyable.
Thanks, Alan.
Thanks, Alan.